Vasu Menon joins us from there now. Vasu, good morning. Thank you for joining us.
Thank you for having me.
Vasu, do you expect anything concrete to come out of the finance ministers' meeting in Luxembourg today?
Well, if you look at what's happened in the last couple of months, they've had lots of meetings and nothing concrete has come out of any of those meetings. So I don't expect anything different from this meeting. Lots of rhetoric, lots of show of unity, lots of verbal support. But, you know, what the market really needs are concrete measures. And I don't think we're going to see that happen just yet, not at least for now. I think hopefully it'll come out in the next couple of months.
And does that mean, Vasu, in the interim, if we don't get anything for a couple of months, we're going to see more volatility in these equity markets?
Without a doubt, I think our view is that volatility is going to be a fixture in equity markets. The European debt crisis is quite deep-seated. It will take quite a while before we resolve this. Clearly, European leaders are dragging their feet. They're behaving like ostriches, you know, and ignoring the problem to some extent. Unless they deal with it, come out with concrete measures, as Rubini said, pull out the bazooka. You're not going to see this go away overnight. Volatility will remain a fixture.
Still, Vasu, you are positive on equities in the medium term, but what do we do in the near term? What do we do until we get something concrete from officials?
Well, you know, I think it's possible the Europeans could surprise the market. Very unlikely, but possible. But, you know, if that happens, then markets could turn around very quickly because there's abundance of liquidity sitting on the sidelines waiting to enter the markets. Markets could rebound very quickly. So given that sort of scenario, what we're telling our investors at this juncture is to invest gradually over the next 18 months. So if you have, say, $180,000, you want to invest in the market, spread it out at a rate of $10,000 per month for 18 months. And stagger your investments, because I think nobody can be sure where the bottom is, and valuations are expensive for equity markets, which is why we are medium-term positive, and liquidity is hugely abundant, and that could swing markets higher the moment sentiment improves.
So stagger your investments, Vasu, over the next 18 months. I mean, talk to me about asset allocation. Specifically, where should we be putting our money then?
Well, you know, if you look at the world, clearly the growth opportunities really lie in emerging markets in Asia. If you look at the forecast out of the IMF, other international agencies, clearly Asia, emerging markets are going to grow at a much faster pace than what you have out of the West. The US and Europe are sitting on a mountain of debt. Austerity measures are going to hurt the economic growth prospects going forward. On the other hand, Asian governments have huge amounts of reserves. They'll be able to stimulate the economies and they'll be able to grow at a much faster pace. And the same applies for Asian companies as well. They are embracing corporate governance, paying out high dividends. So the story for Asia, emerging markets, is quite positive. And anybody investing in equity markets clearly have to look at this region, both in terms of equities as well as bonds. And I think currency will be an additional kicker. Asian currencies will do well despite the recent pullback. The other area we like, commodities. Yes, they have pulled back quite significantly, including gold. We see commodity as a good medium-term structural story. It's pulled back because of the stronger US dollar, but it presents a buying opportunity on dips. We are quite positive across all the commodity asset classes, from soft commodities because of poor weather conditions to base metals because of infrastructure spending in emerging markets, and gold, which we think is emerging as a distinct asset class.
Okay, Vasu, thanks for joining us today. Vasu Menon there, head of research at OCBC Wealth Management. Now,